percent of Djibouti Telecom, 40% of GHIH, which has 27 subsidiaries, all the ports, all the free zones, Air Djibouti. So that's a significant chunk of the GDP, and then 100% of electricity of Djibouti. So now back then, it's about 3-something years ago, there was a valuation of this initial portfolio. That's the way I think you should describe it. I mean, capital is irrelevant. This is what I started with. That's the portfolio we started with. Book value is about $1 billion. Now, is $1 billion a lot if you're in $1 trillion economy? No. But when you are a 3.5 billion economy, then that's a significant number. Because, and why I say this, because I'm part of the, we've joined quickly the IFSWF, the International Forum for Sovereign Wealth Funds. And when I meet my peers and we meet in the annual general meetings, they say, any sovereign wealth fund that has about 10-20% equivalent of GDP is quite significant. Now, 1 billion out of 3.5 is like 30% already. So that's, we started there already. Plus, over the years, so that's book value. It has not been revalued market value, but I know. As the fund manager of it and the manager of the fund, if we did the market valuation today, it should be higher than that. How much higher, I cannot tell you, because that is not really something in the public domain. But so we started with about $1 billion worth of assets on book value terms, and over the years we get dividends from these highly profitable companies. These are the blue chips, if I could call. Yeah, they are all profitable, doing well. So we get them 100% of the dividends of Telecom and 40% of GHIH, and we get also on top of that 20% of the military bases annual revenues. So with all these military bases, it's about $125 million of revenues to the state of Djibouti, which is a significant chunk of the budget, the annual budget. So that's okay. Look, it's more stable than oil and gas. It doesn't fluctuate. That's the beauty of it. Also, I think the revenues from rental revenues from military bases is that they're stable, or maybe they can be revalued when you renew the contracts with the various governments. So that's about $125 million. We get 20% of it, so $25 million a year that comes our way, and that's where we are today. But there isn't anything public that I could share with you, so you just do the math. We started about $1 billion, we continue to grow with some cash flows, and we're in the process of investing and deploying some of that capital. Because you need to remember also that I've only been on this job for about 2 years, not 20, and because the mandate by law, FSD law, very transparent and all good governance, it's right there, you can access it. What does it say? Well, it says we'd like this sovereign wealth fund, a bit like what I said this morning, like any sovereign wealth fund that's balanced. So it's roughly the long term, 50% invested in Djibouti, 50% invested internationally. Ideally, the international bit should be invested regionally first, in the East African region. Maybe there are some projects where there are synergies between us and Ethiopia, maybe us and Kenya, Somalia, South Sudan, whatever it is. But then Africa, and then the world. The reason I say this is because that's how sovereign wealth funds, for example, take the Singaporean ones. Today they're balanced, and 3/4 of the Temasek portfolio today is actually outside of Singapore. So yes, Temasek and GIC, they've lost the second one. One was in 74, Temasek. It's done so well, they said that's not a national. Other one, GIC. Both have about $1.2 trillion of AUM. It's about 2.5-3 times the size of their own GDP, which tells you that they've done so well investing it, growing these intergenerational savings pot, which means in rainy days they have a buffer as a country, just like the Norwegian Sovereign Wealth Fund or many other sovereign wealth funds. Part of their mandate is to be there for rainy days, and so they're kind of counter-cyclical in case needed, but that's not the main role. It's not like every year they contribute to the budget of the country. No, they are there, first of all, to build wealth, to create wealth for future generations, to transform the economy and do things, and diversify the risk, because you don't put all your eggs in one basket. So the idea, just like with you as an individual, I mean, you should be saving on a regular basis every year, whatever, you save $1,000 and then another 1,000. Over time it builds up, and you need that, because without savings it's too risky, or maybe you need it for for your kids' education or healthcare, for retirement. A country exactly the same way. The sovereign wealth fund of a country is that savings for the country, for the future generations, and you can see the success of Singapore, the Gulf countries, Norway, all of that. So that's where we are, but we need to walk before we start running. So we are still in the early stages where we are building the second bit of the portfolio. So we have a portfolio, so we need to do better with it. What do I mean by do better? Well, these are state-owned enterprises. Of course, throughout history, the last several decades, state-owned enterprises very often either they get privatized or something is done to improve their management, their governance. That's part of our role, is to improve the governance of the SOEs that we have.
Yes.
Djibouti Telecom. So I am the chairman of Djibouti Telecom. I sit on the board. I sit on the board of GHIH. But the mindset now is changing and evolving. It's all evolving because they were not used to having someone who is acting like a shareholder.
Yes.
So now we're seeing the difference. There used to be one board meeting a year. Now we do 4 board meetings a year. These are key indicators that tell you that it's a matter of when, not if, we're gonna get there. So we are on the right track of getting there, to improving things, but things take time, as I said, and maybe you don't see to the naked eye immediately, but over time, I think. So my view is, okay, I've been here for about 2 years. I think we've done quite a bit in terms of making sure that we build the human capital from scratch effectively. We build the systems. We build the relationships with stakeholders here, and because stakeholders here is the authorities of Djibouti. The oversight is done by the presidential office. So this is how we are. Some countries you have it under the oversight of the finance ministry. Some other countries you have it under the oversight of the central bank, and some countries under the top leadership of the country. That's where it is in the case of Djibouti. So there's no one size fits all. There's that, and this. We are in this kind of, and I like it certainly, because when you have His Excellency President Ismail Omar Guelleh, who's your direct number one boss, yes, he's your direct boss, then it's a pleasure to work with him. It's a pleasure to see someone who's there. He's like, let's do things, let's keep it. And he helps also get things forward, so there's no bureaucracy also to speak of. This is the beauty of it. I think someone mentioned it. It's a bit of a private sector mindset in a 100% owned institution by the state. Yes, we're 100%, but I come from the private sector, except for the 3 years I was minister, but my 3 decades career is international and private sector. So that's my software. It was useful to work in the public sector as a public servant or civil servant, and that's been useful also here, where yes, it's the state, but then we need to operate and this is why the recruitment is only by headhunters. So this is also something quite new in Djibouti. I mentioned it. Maybe it's nothing big in other places, but no. Headhunters is not. We don't have executive recruitment really as a common thing in here. Great. So we are leading by example, and the people who we recruit, they're so proud. They're going through the interview process, etc. It may sound not so much for some, but it's a big thing to focus on meritocracy, focus on the best, and focus on talent, and so it's a lot of things we do at the same time that are taking shape, which will, I think, be a bit more tangible, I believe, in 3-4 years' time. So therefore, 2-ish plus 3, that's 5. I think 5 years, then you can. But after 2 years, from a startup. So this is a startup. This is not like the central bank has been around for decades, or Ministry of Finance has been around for decades. This is a brand new institution from scratch. There's nothing like it. You don't copy and paste. We're making it all. But it was well thought of from the very beginning, inspired by others. So how did they do it? How did this model work? This is why, okay, we don't have oil and gas in the Gulf countries like Norway. But Singapore has done it this way. Let's do it that way. And of course, we are in 2024 today, so we can learn from the past and avoid, the learning curve. So we can fast track things. So whatever took 30 years for others, should take us 5-6 in our case, all else being the same. Now the second bit of the portfolio is the one we're developing to diversify. So the recycling of these dividends, which used to be invested straight by Djibouti Telecom or going to the state as revenues, or GHIH going to more ports activities. Now, diversifying the economy along the lines of Vision 2035. So the guiding really path for us is Vision 2035, which is brilliant. At least you know where you're heading. You know, like, you know you have this roadmap. We want to head there in 2035. We want to have a tourism hub attracting 500,000 tourists. We want to have 100% green energy. We want to have create a couple of 100,000 jobs. Being a hub for for digital economy and therefore data centers. So we work on all of those. Now, can we do everything at the same time? No. As I said, I'm not Santa Claus, I don't have a magic wand, but we should do our very best in all of those. Some will happen quicker than others, and I go back to it's a matter of when rather than if. So by 2035, we should be achieving all these objectives. Some may be fully at 100%, maybe some are, but renewable energy and green energy, we're going to be at 100% renewable by 2030. So way before 2035. Why? Because we've done a great job, I think, the last couple of years getting the wind power up and running, getting solar projects now we're working on soon up and running, but they're basically ongoing. So by 2030, we'll be probably the first African country, if someone corrects me, that will be 100% green energy by 2030. Green meaning wind mix, energy mix, solar, because we have them, and we're working on geothermal, because we need also a diversified mix, because sometimes you can't, I mean, whether it's because you don't have enough sun or you don't have enough wind, so you need the intermittent, whatever it's called, intermittent power or continuous power, whatever it's called technically, so that it's in case there's not enough battery storage for solar energy or the wind, then you have this one kicking in maybe at midnight or 1 a.m. or whatever. So, but geothermal is green. But geothermal, we know it's in this part of the world hugely successful in Kenya. So KenGen, quite a success story with geothermal. We do have geothermal, and Ethiopia has it. So each one is working on it. We didn't strike not gold. We didn't strike geothermal energy, because geothermal is actually wells. It's drilling until you find the geothermal energy, which means a lot of capital needs to go into drilling, like oil. I mean, unless you're some of the Gulf countries, you drill and you have oil coming out of the ground. Geothermal here, you could do 10 wells and it costs money, and you may not get there yet. So it requires continuous capital from international partners, and that's what we're working on. But going back, so to the 2035 vision. So we know where we want to head to with this lovely country. So renewable energy, tourism, digital economy, financial markets. Yeah, that's about it. But can we aspire to be this major aeronautics manufacturing hub here? No, not anytime soon, because we don't have the comparative advantages. To become, for example, I take this extreme example of being a major aeronautics manufacturing hub, you need a lot of industrial manufacturing in here, you need a lot of skilled labor. So maybe in 30, 40, that's what countries like Tunisia and Morocco have done. So in Northern Africa, Tunisia and Morocco, initially Tunisia, did stand out of the crowd to industrialize, helped by the EU. So first free trade agreements. So it's a bit like Mexico for North America. So the southern Mediterranean or the North African became these great outsourcing hubs. So auto components, aeronautics, pharmaceuticals, textile and clothing, lots is producing there. Now this is what we should be also doing in Djibouti, is industrializing. Now, we should also be realistic that this is a very young country. Independence happened in 1977. French, in 77, there were 5 Djiboutian high school graduates. So going back to education, yes, that's the case. Colonization has not been that great for Africa. I think it should not be the elephant in the room. That's the reality of it. So 77, end of colonization. Education was not that great. So today, we have a university. We didn't have a university 20 years ago. We have one that's at 11,000 students. And this morning, Charlie Robertson did pick on education. It's come a long way. And he's like, wow, I didn't know that Djibouti has come from that. Yeah, so I think we're on the right path in terms of the human capital being built. Next stage is trained human capital. So educated, yes. Then you need to be trained to the right skills needed, and industry. So now we have the free zones. Amazing, they're there. The international Djibouti International Free Zone, 47 square kilometers. It's the biggest in Africa, but there's not much yet in there. Part of it is the cost of energy. So this is one of the hurdles that we need to overcome, and we're working on it. So as long as we know where the challenges are and we are addressing them, then it's just a matter of time. So we know that the cost of energy, and likewise, Charlie Robertson said, great on the education, but cost of energy, you're kind of an outlier. Over 30 cents kilowatt hour is a lot. The average in Africa is 14, 15. You want to bring it down to 10, 11. Then I was Minister of Manufacturing Industry and SMEs and Energy, Mining, in Tunisia. I mean, Tunisia has several thousands of industrial firms. South Africa has tens of thousands. So now that's just Africa. Of course, there's industrial firms in Europe, all over the world. So to attract some of those, we need to have the prerequisites. Prerequisite is an available quality of energy at a decent cost, or attractive cost. Okay, so it's not there yet, but this is why we're working on it, and I think in 12, 18 months' time we'll be in a much stronger position to then get going with some of the industrial projects coming in here. But it means that as long as that's the path, by 2035, are we going to become this amazing manufacturing hub, the biggest in Africa? I don't know, I mean ideally, but most importantly is that today, the economy, look at the GDP, it's about 3/4 public sector driven. And then about a quarter, not even, is private sector. We need to inverse that. So if you look at countries like, I can't remember the split of GDP in South Africa, but I know that Tunisia, Italy, France, the UK, the US, it's the private sector that's really driving the GDP, and within the private sector is the SMEs, right? So that's where we should be heading, but I go back. It's also because Djibouti's recent history is relatively young. It's only 45 years since, first of all, you can get the education going, the infrastructure and the healthcare, and the next stage is getting the private sector to take, a bigger part of the burden. That way. So education, healthcare, there should be more private schools, there should be more private clinics. It's been done elsewhere. We know. We won't go too far away. But once again, Northern Africa, Tunisia, Morocco have now booming, private education sector, booming healthcare sector, and that's the kind of things we need to see here. Is we need to see more private sector initiatives. Now it's easy said, done. So we play our part also, part of our mandate, and I go back. So improve the corporate governance. We talked about this. Obviously, coming from London with a couple of decades with the Financial Services Authority of the UK. Basically, as the regulator and whatever, I've worked on the investment banking, investment management. So I bring this know-how, and bring this added value, along with the CIO, who was also at BII, Bishop International Investment in London. So the two of us came in here, and we've hired mainly Djiboutians to bring all this know-how. Improve the governance. Number two, diversify the economy. Well, it's easy said, but I just said we do that. And the private sector. So within that, we need to boost or be the catalyst for the private sector to do things. And now, 2 years ago, I didn't know many people. Today, most of the private sector champions were here in the room, and building the relationship with them and convincing them that let's do this, let's do that. And the ideal combination from a sovereign wealth fund and from I think a state point of view, the best kind of capital structure would be the sovereign wealth fund of Djibouti as the P for public, and then the P for private in terms of PPP, P from the private sector of Djibouti, and P for private sector international. That's the ideal combination. Why? Well, PPP is a great model to do. So once again, there's the multiplier effect. Let's say $100 million from sovereign fund of Djibouti. I could do one project, or I could do four with 25, 25, 25, 25. So if I could split it into 4 projects where they all require $100 million, I could do one on my own, or I could do 4, because I put 25 here, and someone else puts 26, 75, whatever it is, 25, someone else puts 75, and that's your $400 million with our 100 in equity. But projects never get financed all in equity. You need to have some debt financing, project debt financing. So solar projects worldwide is usually 30% equity, 70% project debt financing. That's the model it is. Now in the projects we are in the renewable energy, that's the way it is. But we want to be a bit more cautious and prudent about it. So we said, let's say it's 50%, not 70% leverage. So so 50 equity with the $400 million, we should be getting also about 400 million in project debt financing. So that's $800 million with 100 million. So the multiplier effect that we bring in, I didn't mention this morning. I could have spoken for 25 minutes, but because it was there, I had to shorten it, and I kept shortening it. But the multiplier effect, I did not really highlight it. I'm delighted that we remembered it now. $100 million from the Sovereign Fund of Djibouti could and should create $800 million. $800 million is like a quarter or 30% of GDP of Djibouti, right? It's a big chunk, you know? Not in one go. It's got to be executed over 3-4 years. If it's data centers, by the time we press the button today, like we did with banks, you know, the first groundbreaking things will take 18 months between the due diligence, the financial closing, and all of that. So, 3 to 5 years. I mean, the wind power took several years. So going back, so in here, why I said it would be ideal. So we'll be 25% shareholder, ideally X%, whatever it is, private sector from Djibouti, and whatever private sector from international. Why the international? Because the international should be bringing two things to us. First of all, FDI is crucial everywhere. It's been talked about today. Because FDI brings capital, but it brings know-how. The idea is not just capital. Capital is easier to get than human. Financial capital is easier to get than human capital and the know-how. So that's why we keep focusing on this added value that we could bring in. Because there's nothing, of course we'd love to get the local private sector involved. And as I said, ideally we find these world-class partners